welcome back to this week's market update. Today is Tuesday, February 17th, 2026, and we will jump right in. Stocks fell last week as investors rotated out of risk-on technology and financial names and into some more defensive sectors. As a result, the tech-heavy Nasdaq Composite led the decline, down 2.1% last week, followed by the S&P 500 down 1.4% last week, and the Dow holding up a bit better, down 1.23% last week. Dispersion across sectors was pretty significant during the week, with utilities outperforming up more than 7% last week, followed by real estate and materials also up quite a bit, up more than 3% in each of those sectors. On the other hand, we saw financials sell off about 4.8% last week, part of that due to some recent proposals to cap interest rates on credit cards. Other sectors like consumer discretionary and technology also took a bit of a hit, with technology making up a significant portion of the indexes, hence why we had a lower week last week. Now, moving into some more economic data from last week, after a brief delay due to the partial federal government shutdown, January's BLS employment report came in broadly better than expected, providing a positive surprise for the markets last week. The US added 130,000 jobs in the month. Now, this is still a little bit below the long-term averages, but as you can see, this is the strongest month in quite some while here, so that is a good sign there, and more than twice the expected 53,000 jobs. Job gains were concentrated in healthcare, social assistance, and construction, while federal government and financial services posted the largest declines. The unemployment rate edged lower to 4.3% here in January, beating expectations of 4.4% and signaling some continued stability in labor market conditions. Last but not least, wage growth was pretty firm, with average hourly earnings up 0.4% in the month of January and up 3.7% from a year ago, extending the trend of real wage gains. In contrast to the stronger than expected jobs report, December retail sales came in softer than expected, remaining flat for the holiday month compared with estimates of about 0.4% growth expected. On an annual basis, retail sales increased 2.1%, a pretty subdued pace for the holiday season, also slower than the pace of inflation, so real spending was actually down slightly from a year ago, a sign that some consumers may be pulling back on spending. Weakness was broad-based, with auto sales declining 1.1% from a year ago, also declining in the month, as you can see here. However, food and beverage sales did provide some support, up 4.7% from a year ago. Overall, though, it does seem to be a bit more of a subdued holiday spending season and suggests that consumers may be becoming more selective in their spending. We also got the January CPI print last week. It came in slightly better than expected, with headline CPI at 2.4% from a year ago, up 0.2% from a month ago, and then core CPI up a little bit more, 2.5% from a year ago, and 0.3% in the month. Looking at some of the drivers, groceries were up 2.1% from a year ago, so that has been moderating in a positive direction there. Food away from home, aka dining out, that was up 4% from a year ago, showing that restaurants seem to have still some pretty strong pricing power in that category. Energy was down 0.1% from a year ago, but when we look beneath the surface here, you can see energy commodities. They were down 7.3% from a year ago, which includes gasoline and fuel. On the other hand, energy services are up quite a bit from a year ago. So they were up 7.2% from January 2025. And within that, we have electricity up 6.3% from a year ago. Gas service up 9.8% from a year ago. So a lot of disparities between the different categories of energy prices there as well. And then last but not least, we've also seen shelter inflation moderate quite a bit, up to just about 3% in the month of January from a year ago. So that has been moving in a positive direction as well. Last but not least, we did get January's existing home sales data here. It showed that home sales were pretty sluggish in the month, down 8.4% from December, and also down 4.4% from January of 2025. Inventory was up 3.4% from a year ago, leading months of supply to increase to 3.7. And then the median sales price rose at a very minor 0.9% over the year to 396,800, leading the affordability conditions, according to this one metric here, to show that the housing market is the most affordable since March of 2022. So with real wage gains, with interest rates coming down, that has been helping affordability quite a bit in recent months. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.